Welcome to Stock Market Palantir. In this video, we'll be breaking down another stock analysis. Be sure to subscribe and drop your opinion in the comments. Okay, let's hear from our analysts.
Our focus today is on Multiways Holdings Limited, ticker MWG. It's a Singapore-based industrial equipment supplier that, well, it basically became the absolute epicenter of market focus in late December 2025. And this wasn't some modest stock move. It was a vertical launch.
Right. In a single trading session, the stock surged over 120%, and the volume was just astounding. It exchanged over 15 million shares.
15.06 million, to be exact, which is a huge shock when you consider its 20-day average volume was barely 12,000 shares.
And that explosion, that catalyst, was the release of the unaudited H1 2025 financials. These results showed a pretty transformative period. We saw an 87.65% year-over-year surge in revenue, climbing to $26.44 million, and then there was the net income.
A staggering explosion, a 1,025% increase, rising to just under $1 million. So the numbers are, undeniable. Which brings us to our central question. Was this staggering appreciation primarily a justified fundamental repricing, reflecting a massive, and I'd argue necessary, operational turnaround? Or was the extreme magnitude of the move driven more by the, let's say, the fragile plumbing of the microcap market? I mean, things like illiquidity, market mechanics, and just pure speculation. I argue emphatically for the fundamental justification. The numbers demanded this move.
I come at it from a different angle. While I acknowledge those financials provided the spark, the resulting volatility was severely amplified by inherent market structure problems. I'd argue that those structural factors drove the price action into a chaotic event that goes far beyond what the underlying quality of those earnings truly supports.
Well, I see the surge as a rational and, frankly, a necessary reaction to the removal of an existential threat. I mean, before this news, MWG was trading near its 52-week lows, right? Hovering between 21 and 25 cents. The market had priced this company as severely distressed, a bankruptcy candidate. And the most significant, the most bullish signal was that binary switch in liquidity and cash flow.
Okay.
Just consider the context. In H1 2024, the company was hemorrhaging money. It reported a negative operating cash flow of $8.03 million. For a company this size, that's an immediate existential crisis. But then, in H1 2025, that cash flow position swung violently, not just to zero, but to a positive operating cash flow of $5.39 million. That fundamental pivot, moving from burning $8 million to generating over $5 million in cash in just 6 months, it just instantly obliterated the solvency risk. And crucially, management explicitly linked this jump to ongoing major infrastructure projects in Singapore. This validates that MWG is a direct beneficiary of massive, multi-year government investments, like the Changi Airport Terminal 5 project, the MRT line expansions. The market was forced instantaneously to re-rate this stock from distress to growth.
I see why you think that. And sure, surviving insolvency is the baseline for any investment. But let me give you a different perspective on that sudden valuation leap. The structure of this company's equity, it just guaranteed that any positive news would be violently overexpressed in the stock price. MWG is extremely illiquid. We are talking about a low public float, the shares available for trading, estimated at roughly 28.45 million shares. Couple that with a pre-news average volume of just over 12,000 shares, and the setup was a volatility time bomb.
A time bomb waiting for a good catalyst.
Exactly. But we also have to dive deeper into the sustainability of those headline figures. Yes, top-line revenue soared by 87%, which sounds magnificent. But if you look beneath the surface, the gross margin collapsed. It drops from 33% down to 25%. That's nearly 800 basis points of compression. This is a critical indicator that the revenue was generated via high-volume, lower-margin equipment sales, not their resilient, higher-margin equipment rentals. This shift suggests the company faced, and I'm quoting them, heightened competitive pressures. They chose volume over profitability. And finally, we have to debunk the narrative that fueled all the retail excitement. The massive volume led to widespread chatter online about a short squeeze. It is essential to understand that the official short interest is negligible. We're talking 0.02% of the public float. The price action was not driven by shorts scrambling to cover. It was driven by genuine, long-side demand meeting an institutional vacuum of supply. That's a structural factor.
Okay, let's address that tension between cash flow and margin compression directly. For a microcap industrial operator, a positive $5.39 million cash flow turnaround in 6 months is not merely high quality. It is an operational and financial lifeline. The company was fragile. It needed liquidity to survive, to fund operations, and importantly, to finance future fleet acquisition to meet that Singapore demand.
Sure, liquidity is key.
They achieved this by ramping up equipment sales. And yes, that temporarily dilutes the overall gross margin percentage. But margin efficiency is a long-term goal. Liquidity, survival, and securing market position in a boom, those are short-term necessities. The choice to sacrifice 8 points of margin to secure that cash and capture market share in a massive infrastructure build is a strategically rational decision that absolutely justifies the repricing. They solved their most pressing problem first.
That's a compelling point about the necessity of solvency. But I would frame the cost of that liquidity very differently. Solvency is essential, of course, but the margin collapse is a critical negative signal about the sustainability and the long-term profitability profile of the business. Investors need to ask, are they creating value or just accelerating revenue?
I think they're creating value by staying in the game.
Well, look, the equipment rental business is typically a high multiple, sticky, reoccurring revenue stream. That's what those 33% gross margins support. The equipment sales business is low multiple, transactional, and subject to intense competition, which is what the new 25% margin reflects. By focusing on sales to generate that cash flow, the company is fundamentally shifting its business mix toward a lower quality revenue profile. They're essentially liquidating inventory to generate cash. If they keep doing that, they look less like a specialist renter and more like a general equipment distributor, which commands a substantially lower valuation.
But that premise assumes the demand is finite. The market isn't reacting to a generalized sales push. It's reacting to the fact this company is positioned directly in the path of billions of dollars in guaranteed government spending. If they use sales now to establish relationships and capture market share on the biggest construction projects in the region, the long-term high-margin rental contracts will follow. They're using sales as a strategic entry point. To assign a liquidation risk is to fundamentally misunderstand the scale of demand from a project like Changi T5.
Let's turn directly to the mechanism then, because this is where the volatility moves from just understandable to fundamentally confusing for the average trader. I maintain the price move was overwhelmingly mechanical, a float rotation event. The volume, over 15 million shares, means that a full 53% of the outsiding public shares turned over in a single day.
A huge turnover, yeah.
Because the stock was so incredibly illiquid, remembering that tiny average volume, the entire market apparatus was unprepared. Market makers, the wholesalers who use systems like dark pools to match orders off exchange, they had minimal, if any, inventory to meet that sudden surge in demand. When demand hits that vacuum, they are forced to instantly widen the bid-ask spread and aggressively raise the price to attract reluctant sellers. This forces price discovery onto the lit exchanges. The price literally had to teleport because there was no liquidity to trade sequentially from 25 cents to 26 to 27 and so on. The price jumped from the high 20s immediately into the 40s. The structure created a pricing vacuum.
I'm just not convinced by that line of reasoning because while the mechanics you describe are accurate, structure is secondary to causality. The illiquidity is merely the narrow pipe. The demand is the pressure that burst it. The demand shock, that flood of long buyers, was directly and primarily caused by the 1,025% net income headline, and critically, the removal of the solvency risk. To suggest the volatility obscures the quality of the earnings misses the point. The volatility was the realization of the quality. Market structure only served to violently accelerate the speed of a justified repricing.
If the earnings had been poor, the float rotation would have happened downwards. The direction validates the catalyst.
That's fair. The direction was dictated by the news, but the magnitude and speed were structurally mandated. If this stock had robust liquidity, say average daily volume of 500,000 shares, the move would have been spread over several sessions, allowing for more rational price discovery. The current mechanism forces a single manic spike. And I'd challenge your assertion that the repricing was mandated. If the data mandated a price in the 40s, why did the lack of liquidity stop it there? Didn't the structural constraint potentially cap the move as much as it accelerated it?
That's an interesting point.
And that volatility is compounded by genuine external confusion. Traders entering the stock must be aware of the ticker collision phenomenon. We know erroneous reports of past stock splits are circulating online. This noise stems from confusion with Mobile World Investment Corp., a massive Vietnamese retailer that also uses the ticker MWG.
Looking at the wrong entity. The NYSE-listed entity has executed 0 splits. And compounding this, just before the surge, the company executed a registered direct offering, raising about $1.5 million. That's a mechanism where new shares are sold privately, diluting existing holders immediately before this massive run-up. The combination of data noise and prior dilution adds significant risk.
That's a compelling argument about the data noise. However, let's pivot back to the fundamental governance risk that is actually relevant to the NYSE entity, because that speaks directly to valuation. MWG is designated a controlled company. MWE Investments owns approximately 61.8% of outstanding shares. This controlling structure warrants a substantial valuation discount. Why? Because minority shareholders have virtually no say.
Right.
The controlling shareholder can dictate the terms. Typically, the market applies a discount to the value to account for this. The fact that the market is now aggressively bidding up the price, moving it far off its lows, despite the illiquidity, the margin risk, and this explicit governance discount, it just demonstrates overwhelming confidence in that Singapore infrastructure pipeline. Investors are choosing to overlook the governance discount because the fundamental growth engine tied to projects like Changi T5 is simply too powerful to ignore.
I agree. The market is willing to overlook it. But I'd argue the pricing mechanism distorted the true price for that governance risk. The volatility eliminated the ability of rational actors to step in and properly price that risk, forcing a rapid and perhaps temporary overcorrection. The question remains, is the current valuation sustainable once the float has fully rotated and liquidity returns to its normal negligible state? So to summarize my position, while the revenue growth is undeniably strong and the cash flow turnaround is a massive positive, investors must filter the severe structural noise to arrive at a sustainable valuation. This means filtering the negligible short interest, the extreme margin compression, and the fact that the price action was a mechanical gap up forced by illiquidity. The extreme volatility reflects a market vacuum, not purely a definitive or stable change in long-term operational quality.
And conversely, the financial pivot from a company burning $8 million in cash to a $5.39 million cash-generating operator is a definitive, game-changing fundamental catalyst. The stock was massively undervalued at 25 cents based on the market's failure to recognize its direct exposure to the Singapore infrastructure boom. The price action, while violent and amplified by the low float, was a necessary and rational reflection of this fundamental transition from a firm facing insolvency to one with validated growth in a multi-year pipeline.
The MWG event really does provide a fascinating look into how genuine financial catalysts, driven by monumental real-world infrastructure development, interact with the highly constrained and complex plumbing of the modern microcap market.
It reveals that explosive price appreciation is often a complex collision of powerful, undeniable fundamentals meeting extreme structural scarcity. And it leaves the investor weighing the certainty of the numbers, that cash flow turnaround, against the chaos of the microcap trading environment.
If you enjoyed this video and want to watch more analysis like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching, and see you in the next video.